All right, it's 10 o'clock, so I think we're going to get going just so we can get through everything we've got today. Good morning. Welcome to Maynard Costerisan's and ADP's year-end payroll webinar. Just a few housekeeping items. This session is being recorded and everybody is muted. If you have questions, please type them into the Q&A chat function. The regular chat is going to be closed, and then the presenters are going to be answering those questions as we go through. We'll be sending out a recording of this later this week along with the slides that we go through today, so you can expect to see those. And with all of that out of the way, I'm going to hand it over to Tony to get started. Tony, you are muted. You have to unmute real quick.
Yeah, I lost my screen there, but thank you everybody for joining us this morning. I'm Tony Horsch, a manager in the Accounting and Outsourced Solutions Department, and I've been with Maynard for more than 25 years. I work mainly with small and mid-sized businesses, helping with accounting and payroll, and I've worked with many different industries and nonprofits. So today I'll be more in the background answering the questions in the Q&A, so type in any questions you've got. If we can't answer something right away, we'll try to get you the answer as soon as we can. I think this is just a good chance to get you thinking about what needs to happen for payroll at year end and what's coming up for next year. So we're joined today by our first speaker, who's Madison Lay, a CPA and a manager in our Accounting and Outsourced Solutions Department. She's been at Maynard since 2019, and she supports many small and mid-sized businesses and nonprofits with financials and payroll. And she too is involved in many different industries and nonprofits and provides traditional and outsourced accounting services. And she's got a wide variety of payroll experience on many, many platforms. The second speaker will be Courtney Kelterborn. She's a CPA and a manager with Maynard Costerisan, and she's been with us for over 5 years. She specializes in payroll and payroll tax services, and she has experience working with many different payroll software solutions, including QuickBooks, ADP, Paychex, Gusto, and many others. She works with clients across many different industries and assists with processing payroll, preparing and filing payroll taxes, and responding to notices from the IRS and other taxing agencies. So she's been a big part of our payroll tax team and helps prepare and review payroll taxes. Done that for quite some time. And then lastly, we'll have some guest speakers, Steve Fremote and Emily Jansen, who will speak to us from a third-party payroll perspective, providing advice about reporting non-cash fringes and tracking sick time for the new earned sick time law, and they'll have some other things to tell us about. So take it away, Madison.
Thank you everyone for joining us. So here's kind of an overview of what we'll be covering today. I'll be handling wages and fringes, form due dates and annual limits, and year-end planning, and then Courtney will get into the 1099 forms and vendor payments, and then changes to the minimum wage and sick leave. Just as a precursor, this is not meant to be exhaustive, so we provided a few other references that you can go to, and then as always you can reach out to the Maynard team for help. So Courtney, Tony, and I, and our emails are provided on the slides, which will be sent out to you guys. So getting into wages and fringes. So some of the items on this slide hopefully have been addressed earlier in the year, but can also be applied if you have any new hires. So employee or independent contractor, they can't be both. Employees will differ because they'll have their income taxes, Social Security, Medicare withheld throughout the year, whereas independent contractors, they'll need to pay self-employment and income tax through estimated quarterly tax payments. Form SS8 is a good example to decide if an employee should be coded as or if a worker should be coded as an employee or an independent contractor. We recommend you just use this as a guide, but don't actually send it in. And then you want to be sure to have a valid W-4 for employees to be withholding the correct federal income tax throughout the year. There were 2 small changes to the 2020 for W-4, which in step 2, it directs employees with self-employment income or their spouses to use the IRS withholding estimator, and then updated dollar amounts on the deductions worksheet for filing married, head household, or single. And then if you don't have a W-4, either not signed or you don't have one at all, you should tax the employee as single. And then if you get an error from the Social Security Administration, having a W-4 is your only recourse. And then just a side note for Form I-9, which is employment eligibility verification, just be sure you're using the most recent form, which was updated on 8/1/2023. And then here's just the updated 2024 W-4, and I highlighted where you'll see those changes. So the deductions worksheet on page 3 and step 2A. And then what is taxable? So, and unless there's an exception, it is taxable and should be included on in wages on Form W-2. And technically, there isn't a de minimis with the IRS. $25 is commonly used, but all cash, gift cards, and gift certificates that are redeemable for general merchandise should be taxed. And then the IRS website and publication is where you can find the exceptions. A good general rule is a de minimis benefit if it's occasional or unusual in frequency. That would be considered one, but it must not be a form of disguised compensation. So there's the additional guidance if you need to find specific exceptions or guidance on those items. And then going into fringe benefits that are commonly taxable or non-taxable. Common taxable items are employer-paid group term life insurance, so over $50,000 in coverage, personal use of a company car or a company-paid leased vehicle, and greater than 2% shareholders in an S Corp, their health, disability, long-term care premiums, or HSA contributions. Employee achievement awards, so gifts and prizes. Employer-paid moving expenses, third-party sick pay. So these common taxable items are generally taxed at fair market value, and cost and fair market value are usually the same unless the cost the employer incurs is less than the value of the benefit that the employee receives. If the value of the benefit that the employee receives is more, then that would be the taxable amount. And then also any amount that the employee pays for the benefit reduces the taxable benefit amount. And then a few common non-taxable items are employee business expense reimbursements if they're on an accountable plan. An accountable plan is a reimbursement policy set up by the company that states that there must be a business connection to the expense, there must be adequate accounting within a reasonable period of time, and excess reimbursements and advances need to be returned within a reasonable period of time. So that's what an accountable plan is. And then other common non-taxable items, employer-paid student loan debt up to $5,250 and qualified transportation and parking. So when you're paying out these fringe benefits, they need to be grossed up. So if you didn't already add the benefit to their pay in time to collect employee taxes, or if you're choosing to pay both the employee and employer share, that's when it would need to be grossed up and added to their pay. So personal use of a company vehicle, total miles, based on total miles and personal miles, which commuting is considered personal, there'll be a calculation worksheet included in the handout that we'll send out after to figure out that. Group term life insurance coverage. And then normally to gross it up, you would just use Social Security and Medicare. But the benefits are still taxable for federal and state income taxes. So you would take the total of the benefit divided by 0.9235 to get that gross amount that you'll want to include. And then you can also refer to IRS Publication 15B for more information, and just be aware that once the employee is over the Social Security limit, it gets a little more complicated. And then keep in mind of that $100,000 next day rule for EFTPS payments. So if your liability is more than $1,000 on any day, that must be paid by the end of the next business day. And then state and local, so this is important with more employees working remotely or being hybrid. Pay is generally taxed in the location performed. And then we recommend that you go to specific state and city websites for employer requirements and to pull the correct W-4 withholding forms for each state and city. And then we have a reciprocal state example on the next slide. And you can look at this a little bit more in your own time when we send out the slide deck, but it just shows you four different test examples depending where an employee lives, where they work, and then if the business headquarters are located in a different state, how they should be taxed. And now going into form due dates and annual limits. And I'll try to keep just highlights on this as you'll get the slides. W-2s are due January 31st. 1099 NECs are also due January 31st. And then 1099 miscellaneous, slightly different. They're due to the payee by January 31st. But if you're filing by paper, they're due February 28th. And if you're filing electronically, they're due March 31st. Form 5081, in most cases, it's due February 28th, and state copies of W-2s and 1099s are due by January 31st. Exceptions, so if they're accompanied by 1099 miscellaneous forms, then they're due February 28th when they're paper filed, but if they're electronically filed, then they're due March 31st. So just pay attention, depending if you're paper or electronically filing for those deadlines. Local W-2 deadlines are all February 28th. And then if you are going back and trying to file an amended 941X related to 2021's employee retention credit, that is due February 15th. Social Security and Medicare wage-based tax rates. So between 2024 and 2025, all of the rates stayed the same. There was an increase to the wage base of $7,500 in 2025. So you'll have to get that updated in your payroll system if it doesn't update automatically. And then annual limits. So there's an increase in the 401k plan contributions of $500 and the simple plan of $500 as well. And then HSA, individual and family contributions from 2024 to 2025 have gone up as well. Individual has gone up 150 and family 250. And then also a highlight to note for 2025, there's a new catch-up category for 401k and simple plans resulting from the Secure 2.0 Act. So there's a higher catch-up category for ages 60 to 63. So instead of the normal 7,500 for 401k plans, anyone 60 to 63 in 2025 can actually contribute 11,250. And then for the simple plan, the catch up for people 60 to 63 is 5,250. So that's new to keep in mind. And if your payroll software doesn't do that automatically, you'll have to double check that those amounts are set up that way. And then the year-end payroll handout will have a bit more on this. State unemployment insurance taxable wage bases. Here they are for Indiana, Kentucky, Michigan, and Ohio. There's no changes there. And just a reminder, at the end of December, watch out for your rate determination notice from the Unemployment Insurance Agency to make sure that is updated in your payroll system before the first payroll in January. So now just a few tips about year-end planning and steps to an easy year-end filing process. Develop your timeline from the year-end checklist provided in the handout. And then reconcile first, second, and third quarter payroll tax returns with your 9/30/2024 earnings report. So try to get everything that you can get reconciled done before you're focusing on the last quarter. And then before annual forms are prepared, try to reconcile through at least November your bank accounts, but ideally through December 31st if you can. And then verify your general ledger liability accounts, that those are in balance, that your GL is matching what you're showing as owed. So you want to make sure that's done before the 941s and W-2s are prepared. And then other year-end planning items, so just looking ahead at your processing schedule for 2025, creating a custom schedule and documenting who's responsible, and consider holiday closures, time off to determine when you need to be processing your payroll. And again, that $100,000 next day rule, so tax deposit deadlines, and then reconcile. So compare your year-to-date wage and deduction totals to a preview copy of the W-2 before you send those off to be finalized. So, and I think that's all from me, so I'll let Courtney take it over with 1099 forms and vendor payments.
Sorry about that. I couldn't get the mic to come back on. Hi, everybody. I'm Courtney Kelterborn, and like Madison said, I'm going to be talking about 1099s in this section, and then also briefly reviewing some of the new e-filing requirements that went into effect last year, and then I'll also give an overview of the upcoming changes to minimum wage and sick time that you should be aware of going into 2024. Okay, so let's start with 1099. So generally, you're going to need to issue a 1099 to anyone who has paid non-employment income of $600 or more during the year. Common payments made that would require 1099 would be payments to non-employees for providing services. So, for example, if you have maybe like a freelance marketing person, or you have any independent contractors that you work with during the year, they would have to receive a 1099 from you. And kind of one way to double check that is if an individual is providing services to your business and you don't send them a W-2 at the end of the year, you're probably going to have to send them a 1099. And then in addition to any non-employees that provide services to your business, any non-incorporated companies that provide services would also need to get a 1099. So let's say you hired an LLC to shovel up all this lovely snow we got overnight, they're going to need to get a 1099 from you. And then also any rent or royalty payments that you pay to non-incorporated companies are also going to require 1099. So if you're paying rent to like an LLC, so non-incorporated, you'd want to issue them a 1099. That's not an exhausted list. That's just some of the common ones that we see with most of our clients. Filing threshold for issuing a 1099 in most cases is going to be payments to a vendor of $600 or more during a calendar year. There's a couple exceptions, but we'll kind of call those out as we go, but that's kind of the general rule. Even if you operate on a fiscal year, the amount paid is going to be determined on a calendar year. So it's January 1st to December 31st every year. And it's also important to note that it's only payments that are actually made during the year that count towards that threshold. So let's say you paid a vendor $599 during the year, and then on December 31st, they give you another bill, but you don't actually pay it till January. That wouldn't count towards meeting the $600 threshold in 2024. So in the examples that we looked at, we can see in most cases 1099s are going to be issued to either individuals or incorporated or non-incorporated businesses, but there are some cases where incorporated businesses do have to receive one. So in the case of any payments for legal services, it doesn't matter whether the law firm, sorry about the light is a little bit crazy right now. It doesn't matter if the law firm is incorporated or not. They would still have to get a 1099 for you for legal services. And then also for payments for healthcare or medical billing or collections, you would have to issue 1099s for those payments, even if the vendor is a corporation. So some common 1099 forms that you might need to issue, probably the most common ones are the 1099 NEC or non-employee compensation, or the 1099 MISC miscellaneous form. 1099 NEC was introduced in 2020, so most people are probably familiar with that by now, but that form is going to be used for any non-employee compensation paid to vendors during the year. So your contractors and freelancers are going to fall in that category. And then common things for 1099 miscellaneous would be rent payments and royalty payments. And just something to note with the 1099 miscellaneous, if you're reporting royalty payments made during the year instead of the $600 filing threshold, that's one of the cases where it would be lower. So if you have more than $10 in royalty payments during the year, then you'd need to file the 1099. And then another common form would be the 1099 DIV or dividend form. So that would be used for any dividends or distributions paid to business owners or shareholders during the year in excess of $10. And that $10 can be in money or in any other property that you distribute to the shareholder besides cash that has a value to them. And then also the 1099 INT or interest form is used to report interest paid. Again, the limit there is significantly lower than the usual $600 threshold. Any interest paid in excess of $10, you'd have to file the 1099 INT. For every 1099 type that you file, you'll need to file a 1096, which is just a summary of the information that's on the 1099. So if you file a handful of NECs and a handful of miscellaneous, then you'd end up with 2 1096 forms, one for each type of 1099. Another form that's going to be crucial for filing 1099s is the W-9 form. So the W-9 form is used during the course of the year to collect vendor information that's going to appear on the 1099 later. So legal name, address, and taxpayer identification number are the key things there. So that would be a social security number for an individual or an employee identification number for a business. The W-9 form is just for your use, so it's not something you'd submit to the IRS, but you just want to get that from your vendors and then keep it for your records. It's best to get your W-9 as early as you can. If possible, I would request the W-9 before you even make a payment to the vendor, if you know that you're going to have to issue them a 1099, because like Madison was talking about, some of those due dates, they come up pretty fast after the end of the year. And trust me, I speak from experience. It's not fun to be trying to track down a whole long list of vendors in January trying to get W-9s. If a vendor refuses to give you a W-9, then the recommendation from the IRS is to refuse to issue them any payment because you won't be able to file the 1099. But if you have already issued the payment to the vendor and you're not able to get their taxpayer identification number to file the 1099, it's best not to file it at all, because if you do file a 1099 without the taxpayer identification number, you will receive a penalty from the IRS for improperly filing the form. And if you are requesting that W-9 information and the vendor is refusing, you want to keep records of that as much as possible, because if there is ever a case where you're audited, you want to be able to provide the documentation that you did everything you could to get that information and the vendor refused to provide it. And if you need any assistance with 1099s, you can definitely reach out to your regular account manager that you work with or anyone on our payroll tax team. We're happy to help. Okay, and then just to kind of quickly go over the new e-filing requirements that were effective for forms filed for the 2023 year. For any employer that has to file 10 or more IRS forms in a year, they would then be required to e-file their 1099s and W-2s. I have the next slide in here just as reference as to what counts towards the limit, but it's going to be pretty much any IRS form that you file in a year that's going to count towards the aggregate total. So we're thinking W-2s, 1099s, 940s, 941 tax returns, stuff like that. 1099s can be e-filed for free using IRIS, which is the information returns intake system. And the links to register for that and to get the code that you need for that are on the slide. And then W-2s can be e-filed using BSO, which is Business Services Online. And then link to register again is here as well. Like I said, this is an example list of forms you need to count towards your aggregate total. I just included that for reference, but this list isn't exhaustive. So if you have any questions about which forms count, please feel free to reach out to our payroll team or your account manager, and we can help you determine what your form count is. Okay, so let's switch gears to kind of the hot button topics this year, which are the changes to minimum wage and sick leave. I think there may be some people on this webinar who attended our presentation on ESTA last week, so probably already heard some of this information. You're probably already experts on all this stuff, but I just wanted to reiterate and kind of hit some of the highlights here. So we'll start with changes to minimum wage, because that's minimum wage and tip credit, because that's a little bit simpler and more straightforward. So starting February 21st, the minimum wage is going to increase on an annual basis in accordance with the schedule below. Just to know, there is a bill in the House right now that could possibly change this schedule and make the phase in like a little bit slower. So potentially more to come on that before legislature adjourns, I think next week for the year. So potentially going to change, but at this point, this is the schedule that's going to need to be followed. And then also on February 21st, the tip credit is going to quote unquote increase to 48% of minimum wage, which is up from 38%. And that's going to continue to increase according to the schedule. And saying it increases is like a little bit confusing because the rate's going up, but it's also getting phased out. So the credit is decreasing from the employer's perspective. But basically currently employers with tipped employees only pay them 38% of the minimum wage is like required to be paid to them, and then the rest can be made up by tips. But starting February 21st, employers will have to pay tipped employees 48% of the new minimum wage. So then accordingly, only 52% can be covered by tips, whereas right now 62% of their minimum wage can be covered by tips. And then over the next 4 years, according to the schedule below, the percentages that can be covered by tips is going to keep going down. And then in February 21st, 2029, the tip credit is going to be fully phased out at that point. And then all tips that employees receive would be additional income on top of the employees getting paid at least minimum wage. And as it says, there's no exception for small businesses or employers with a certain number of employees. This applies to everyone as it's written right now. like I said, potentially changes coming, but unfortunately no crystal ball here, so we don't know exactly what's going to happen or when it's going to happen. So then let's kind of quickly knock out some of the highlights for ESTA. So it's going to replace the Paid Medical Leave Act, which we've had in effect, I believe, since 2018. That goes fully into effect on February 21st. So unlike minimum wage, there is no phase in. It is fully in effect on February 21st, 2025. It's going to apply to any employers with one or more employees. Sick time has to be accrued at a rate of 1 hour per 30 hours worked. But the maximum that employee can use in a year is 72 hours, even though there is no cap on the amount that they can accrue in a year. Employers with less than 10 employees have a slight exemption where they still have to accrue 72 hours of sick leave and let the employee take 72 hours of sick leave in a year, but only the first 40 have to be paid. So the other 32 that the employee can take in a year could be unpaid. This includes all workers, so kind of the rule of thumb we've been going with is anybody that gets a W-2 gets sick time. There's no limit on the amount that an employee can accrue or the amount that they can carry forward. And kind of going along with that, at this time, sick leave can't be front loaded because an employee could theoretically accrue more than the 72 hours they're allowed to take in a year. So at this time, front loading is not allowed. Again, couple bills, one or two in the House right now that may change this, but at this point we don't know if those are going to go into effect before February 21st or after, or kind of when that's going to happen. So that's kind of the payroll side. Some of the other things to know. It expands the definition of the uses of sick time to include some additional things like certain meetings and school functions for employees with children. And it also includes time to care for any sick blood relatives or close connections. What's a close connection? I wish I knew. We don't really have a definition for that right now, but that's what the law says is any close connections. An employer can only require documentation if an employee is out for 3 or more consecutive days. And if an employer does require documentation, like from a doctor saying that the employee is sick, the employer is on the hook for any cost to get that documentation. So it's written very broadly at this point. If, the employee, it could cover the copay. If the employee maybe doesn't have a primary care provider and goes to the emergency room, it could include any of the costs associated with that. At this point, it's even been brought up that it could potentially include mileage for the employee to get to the doctor. So it's very open-ended, and none of this has been really clarified or tested in court at this point. So that's kind of where it stands right now. If an employee leaves and returns within 6 months, their sick time has to be reinstated. So probably we've got a lot of people on the call who may have college students who work during the summer, come back at Christmas, come back at, spring break, that kind of thing. Their sick banks would have to be reinstated if they're leaving and returning within 6 months. The changes to ESTA do not supersede any ratified collective bargaining or union agreements. So if you're in the middle of negotiations right now, you might want to plan to get them done before February 21st because they do have to be ratified before that date, or otherwise they have to be ESTA compliant. And then also with the ESTA changes, the burden of proof, if there's ever a challenge in court, has now completely shifted to the employer. So in the past, the employee would have to prove that the employer made a mistake or did something wrong. Now the employer has to prove that they did everything right in order to not have legal ramifications of that. So with that, it's going to be really important to be documenting everything, which you'll probably hear us say several times here. But just to get into some of the payroll specifics, so in order to start accruing sick time, you're going to need to determine which employees are eligible. So just to kind of start off, ESTA applies to all employers. So yes, nonprofits, churches, schools, state governments, anybody who's not the U.S. government is going to be covered by ESTA. And then as far as who's considered an employee, again, as with many things with ESTA, the definition is super, super broad. So their definition is an individual engaged in service to an employer in the business of the employer, except individuals employed by the U.S. government. So as defined, that would include, it seems like that would include independent contractors, but Michigan Wage and Hour Division has come out since the July Supreme Court decision and said that the definition does not apply to independent contractors, but at this point that has not been tested in court. So that's what Wage and Hour has come out and said at this point, but yeah, it's not been tested yet. So kind of as a rule of thumb, you want to make sure that you're tracking and accruing sick leave for anyone that you give a W-2 to at the end of the year. So yes, if you have maybe poll workers that get a W-2, interns. I think we had a question last week about somebody who only works like a couple hours a week doing marketing, but they receive a W-2. Yes, they would get ESTA time. And I know some of my clients had talked about maybe accruing sick leave for independent contractors just to be safe, since ESTA's language was super broad and unclear. But part of the problem with that is if you do track and pay sick leave to an independent contractor, that could be grounds for them to argue in court that they're actually an employee and now the employer should be withholding federal taxes for them, like Madison was talking about earlier. So I don't want to get too far in the weeds on the employee versus independent contractor, but it's important to make sure that all of your employees and independent contractors are classed correctly and separately, and that you're only accruing sick leave for employees. Any employees who work 100% outside the state of Michigan are not covered by ESTA. So if they're hybrid employees that work sometimes in Michigan, sometimes out of Michigan, they're still covered, but fully out of state, you don't have to accrue sick time for them. Kind of up to the employer. If you have like one employee who's remote out of state, it may not make sense to create a whole separate PTO policy just for them, but they wouldn't technically be covered by ESTA, so that's going to be at the employer's discretion. Okay. So now you've decided who's going to get ESTA time. You have to determine what the pay rate of that sick time is going to be. So ESTA time under the Act has to be paid out at the regular or standard wage for any sick time that they use up to 72 hours per year, or 40 hours for employers with fewer than 10 employees. So there's no specific, as far as I'm aware, it's not specifically addressed how this applies to like commission only employees or people who don't have an hourly rate. So kind of the decision that we've seen since then that employers are going to need to calculate an average pay rate for, determining how to pay those employees who are commission only. There's no set time to like calculate it over, but you have to make sure that it's fair. So you want to make sure that if you ever had to present in court why you chose this dollar amount over this many hours, that you can justify that and back that up, and that it doesn't seem unfair to the employee in any way. You don't need to include bonuses in that. It should just be the actual funds that the employee earned for the actual work that they did during the hours that they worked. Again, super critical to maintain records here. If there's ever, a question in court, you have to be able to prove what you paid, the number of hours the employee worked, how you calculated the standard pay rate. So all that's going to need to be documented and tracked. And just kind of as an aside with the hours issue, I know some people who have like salaried employees may not necessarily like track the actual hours worked by their employees. Under ESTA, you're going to have to accrue sick time at the for the number of hours that the employee actually worked. So you are going to have to determine some way to track hours worked for salaried employees before the deadline. I think I already said this, but sick time is accrued at 1 hour for every 30 hours worked, and it's actually hours worked. So it does include overtime, but you do not have to include PTO, holiday, any kind of like unworked but paid time like that. There's no cap on how many hours can be earned on a weekly, monthly, or annual basis. And then sick time has to be tracked and accrued at the same interval that employees track their hours. So for example, if your employees have to track their time down to the 10th of an hour, then ESTA has to be tracked and accrued down to the same increment. No cap on how much they can accrue, is just based on hours worked, but employers are only required to allow them to use 72 hours paid each year. But if they don't use the 72 hours or they accrue more than 72 hours, any unused time is rolled over from year to year, and there's no cap on the amount that can be rolled over or how long it can be rolled over for. And even though it's carried over, at this time, employers aren't required to do any like conversions or payouts of that time annually, or when their employees leave or retire, it'll just kind of sit in the bank for them until they're no longer employed. And then employees who leave and return within 6 months has to be reinstated. So kind of as we're seeing through all this, there's a lot of information that needs to be tracked. So might be, if you've been having the discussion about maybe implementing a payroll software system, now might be a good time to have that discussion again. And then just a couple other quick things from me, and then I'll pass it over to our partners at ADP to talk a little bit more about the payroll system stuff. New sick time policies to cover ESTA can be baked into your current policies if you want to do that, but I think our recommendation is going to be that you separate them because it's going to get really complicated really fast to try to bake all this into one policy. So I would say if you're, spinning yourself in circles and kind of giving yourself a headache trying to create one PTO policy that covers ESTA time and the rest of the PTO you want to give, it's going to be better just to split it out. This is especially important to review we're not HR people, I'll just preface it by saying that, but we do have an HR firm that we work with who's been helping us with some of this stuff. But if your HR policies say that you pay out unpaid or unused PTO, and that's in your employee handbook, you need to change that if you don't want to pay out ESTA time. Because even though ESTA time doesn't have to be paid out under the Act as it stands right now, if your handbook says that any unused paid time off and sick time is paid out when the employee leaves or retires, you do have to follow that. So that's just something you want to be really, really careful that you don't leave that in there because employees could theoretically accrue a large amount of sick time over many years that is then carried over, and you don't want to put yourself in the situation where you're having to pay that out at the time that they leave. Just to mention, most payroll providers can support multiple paid time off policies. So again, from that perspective, probably easier to split out ESTA time. And sorry, just going back to the payout thing, you can leave the payout if you want to keep the two PTO policies separate and you want to keep the payout for your regular payout time and you want to just say, okay, ESTA time is not able to be paid out, you can definitely do that. You just want to make sure that's in your employment agreement. Another reason you might want to split these out is ESTA doesn't go into effect until February 21st, 2025, which is something that we accountants really, really hate since that's mid-quarter, mid-month, mid-week, right in the middle of everything. But to that end, you don't have to accrue sick time for any hours that are worked before that date. So your regular PTO policies probably go into effect January 1st. You don't have to accrue ESTA time starting January 1st. You're definitely welcome to if you want to, but you're not required to until February. So from that perspective, it may make sense to split out the ESTA stuff so that you don't have to try to adjust your existing policy and change it a month and a half into the year. Already talked about this a little bit, but if there are any disputes over sick time, burden of proof is on the employer. So the employer has to prove that they did everything right and be able to document all that. So like I said, documentation is going to be super, super critical. And you want to make sure that you have a good time tracking system that's like ready to rock on February 21st. You definitely don't want to still be testing that on February 21st because you're going to want to make sure that you have all that ready to go and that you're able to document that stuff kind of from day one. And then you need to keep records of any sick time earned or used, and then also any necessary calculations for pay rates like for commission or non-hourly employees. So that is it for me. So I'm going to pass it over to Emily and Steve at ADP. And I'll stop sharing my screen so you guys can share yours.
Thank you very much, Courtney.
I'd be sharing now. Perfect. Can I get a thumbs up that you have a visual? Perfect. Thank you. Thank you. Tough act to follow, Courtney. That was a lot of really great information. And I will say that you set us up beautifully. So we'll start by introducing ourselves. Steve, if you want to go ahead.
All right. I'm Steve Fremont. I've actually been with ADP now 37 years. I've worked with Maynard for 25 of those 37 years. So we're a very close partner because of obviously everything we've been talking about here. It's been even getting better between us. We have a lot of different services. ADP is the leader in the industry. So with that, technology has been going at 100 miles an hour here in the last 3-4 years, really, especially. And Emily, go ahead.
Yeah, so I hate following my introduction from yours because I'm almost at 9 years with ADP, but that is not even close to your 30 plus. And I've worked with Maynard and mutual clients now for, I believe, 7 of the 9 years. I'm local to the Grand Rapids area, but depending upon the day, I'm all over the state, meeting with mutual clients, prospective clients, current ADP clients. So really happy to be a resource. You see my cell phone number on there that will go out after the fact as well. Same number my husband called me on. So anything that you need, you can always reach out. We're really happy to be a resource for you. And Steve, back to you.
All right. Yeah. So So this is from what Madison was talking about and Courtney here. So when we're looking at the year-end adjustments, basically they do the hard work. What you just need to do is get that into ADP. So with this here, it's a matter of filling out a year-end adjustment form, and all the numbers will go on here, whether it's your shareholder taxable, auto, group term life, all of those just get documented on this, and then we get it into client services. Our client services, I'm the 1 to 49 employee company business. So all of that is 24/7 customer service. So you can call in, you can email this over to them and make sure everything gets documented and put on the W-2s here for us. So just the most important is obviously it gets done as soon as possible, so we don't have any problems towards year end. Year end bonuses is another thing here for us. We just need to make sure that the bonuses are in by December 31st at the end of the year here to make sure it gets on the W-2s for us. Okay, and with this here, so one of the things as we're talking about the sick time law, in the last 10 years prior to COVID here, actually, things have really turned to the human resource area. So what ADP has done with our technology, payroll and taxes, that's probably 15% of our business nowadays. What has happened here is everything's going into human resources. So human resources is your handbooks, you're talking to HR specialists to answer questions, you're getting background checks, ZipRecruiter, all of those things now can be done through the software. So it really does bring everything into one platform here for you. Going into the sick time here for us, probably the easiest way, there are two ways to do it here. Your payroll provider should be able to do that just through the accrual process and stuff outside of any time and attendance, but the time and attendance is going to be the easiest way to get that done. This is all now automated, where your employees now can log in and out from a clock that has biometrics. We also have geofencing around a phone that they might use there for them, as well as a desktop. Okay, so everything is automated. There's security in, so you can eliminate the buddy punching options, those type of things for you. But by utilizing the time and attendance, now the manager is able to approve time off, and then it goes into payroll once it's approved, and you can have multiple levels there for you also. So it's a matter of tracking it. The accrual is now visible on employees' checks, and then from there, being able to go right into payroll to hopefully streamline that whole process and everything for you. Okay, there are a lot of other things that we can add to it here, but the most important here for today's conversation is talking about how we get this all into payroll and how everything streams from there. So time and attendance was the key area that we wanted to hit on that for that topic.
Perfect. Other thing to keep in mind too, I know Courtney mentioned salaried employees tracking their hours. So there's so many different ways we can track their hours, even if we're just adding in standard hours and they're adding it to their cell phone, the same app that they use for, you know, maybe a training or to view their pay statement. So ease of use and making sure, I mean, I know your talent, your employees are the most important part of your business, right? So making sure you're making them feel empowered and not, hey, we're going to start tracking you. It's Big Brother, right? Like I've gotten that, I've had that conversation a lot recently. So we want to make sure we're adding value to the company and obviously making the employees feel empowered. So we can take care of that too. The other side of the coin, so I know Courtney mentioned documentation, right? So making sure you're having a place to store everything, you're giving them full visibility into the different, the varying policies as well. They're seeing that in real time. They can look at like effective dating. It makes it really, really easy through our technology. But if you're thinking, hey, Emily, Steve, like it's great that you have the technology to track it, but I'm still looking for more, because as I think Courtney, you also mentioned, like there's no crystal ball, right? This is still in February. We don't know if things are going to change, and you really want to make sure you have a stable partner. We have different levels of support depending upon what you're looking for. So if you're like, hey, you know what? technology is great. I'm good. I just need it to automate. We can absolutely do that. If you're looking for, an HR business partner to come on site and really walk you through what that looks like, we can absolutely take care of that too. Even if they wanted somebody to call into to talk through, health concerns, but you don't want it to be you because you're also running the business and you don't want to kind of dabble in that as well, we can do that too. We have My Life advisors. And then the third option is our PEO. So it's what we call ADP Total Source. So if you're looking to kind of lift and shift a lot of the responsibilities and liability that comes with having employees, that's an option too. So not only do you lift and shift that risk and liability, but you also get the Fortune 500 benefits package. So if you have 20 employees, 40 employees, 60 employees, sometimes it's hard to compete with the Fords and the GMs of Michigan, right? And making sure you're staying competitive. But with ADP, we can help you do that. So I just mentioned that because as the landscape is a little bit more litigious and there's a lot of things, changing, we absolutely want to be there for you. And that's going to look different today, tomorrow, 6 months to a year. So knowing that Steve and myself are here, we've been here for quite some time and we will continue to be regardless of what your needs look like. Just know that you can reach out and we'll be able to assist. Even if you're looking for, hey, it's great that you tell me that we can automate time and attendance. What does that look like? I'm happy to send over a quick 1-minute demo on, hey, how do they track time? What does it look like from a manager's perspective? What does it look like from a practitioner's perspective? Anything that we can do to make you feel more confident going into the new year, we're here for you. So just keep us in the loop there. And then the last slide, and I promise I'll stop talking, is this is just a little bit of a good visual, I would say, on some of the different services that we offer. Steve said payroll's 15%. I've always said 17%. I think it lies somewhere in the middle of what ADP offers now. So when it comes to payroll, of course, that's the heart of what we do. But clients over the years have asked more and more from us because payroll doesn't stand alone, right? Time has to be in there. Recruitment, how do we find the right employees? How do we empower them? How do we train them and upskill them? And then data cloud, how do we know what to pay them, right? And maybe we're in the upper echelon and we're paying them, higher than our neighbors, or maybe it's under and we're offering other types of benefits, right? So ADP can be a resource in all of these different avenues. So if you have any questions whatsoever, like I said, if you're an ADP client, great, we can help. If you're not an ADP client, great, we can help. We just want to be a resource in the community we live in as well. Hopefully that wasn't over our time, but Courtney, I'm not sure if it goes back to you or whoever. I will stop talking and stop sharing.
Yeah, I think that's all the content that we had. I know I've seen some questions in the Q&A that we've been going through answering those, but I think I'll kick it over to Kat to kind of wrap us up here.
Yeah, thank you so much, everybody, for joining. Thank you to the panelists for all of that. We really appreciate you taking the time. We will be emailing out a recording of this along with all of the slides so you can look at those in more detail early next week. So you can look for that in your inbox. And then all of the presenters' contact information will be in there too. So if you have additional questions, feel free to reach out. And that's going to be it for today. And I hope everyone has a great rest of their day.